Okay, let's talk financials if you are going to take a loan out for a car. First thing, you do not need to get the loan at the dealership that you buy from. So you can get a loan from the dealership, you can get a loan from a big bank like Chase or Wells Fargo, you can get a loan from a credit union. That's what I recommend. Credit unions usually have the lowest rates. Right now I'm seeing 2.74% for used cars. And they are really easy to work with. You tell them what car you're buying, you tell them the amount that you're going to spend on it, you send them the VIN number, etc., and they will help you get a loan. Now, a couple things to keep in mind with that loan. You have the loan actual interest percentage, you have the loan term, and the financed amount. Now, here's the thing. With having a loan, it doesn't affect just how much you need to spend a month. It affects how much you are allowed to spend a month. What I mean by that is rent. If you are, excuse me, if you are renting an apartment or a house or you're looking to buy one, your debts, your liabilities are looked at every month. So if you take a car loan, let's say for 4 years, 48 months, that loan is going to be on your liabilities for the next 4 years unless you pay it off early, whether you pay it off with some bonus money or if you sell the car. If you do a longer loan term, let's say 60 months, which is 5 years, yes, your payment might go down, but you're going to have liabilities on you for a longer time. So it depends on if you're going to be moving anytime soon because that $100 liability could be a huge factor into how much more money you need to make on your income statement, on your pay stubs, in order to be able to rent an apartment. For instance, if you're renting an apartment for $1,700 a month and then you have a $100 car payment, and you try and move into a place that's $1,700 again, they probably will not let you if you were just on the brink of getting it. And you can now probably barely afford a $1,600 a month place because you have a new liability on that's not just the car payment, but they know you have insurance to pay for as well, and maintenance with a new car, etc. And by maintenance, I mean, oil changes, tires, brakes, things like that. I'm not saying a new car is going to break down. I'm just saying those are things to keep in mind. Here's an example. If you're going to finance $10,000 and you get a 3% interest rate, if you're going to do it for 4 years, you're going to pay monthly $221. And in total, over the 4 years, you're going to end up paying $10,624 in total. So the interest is $624 extra. You're basically paying for the right, for the privilege of borrowing that money from the bank or credit union, whoever you borrow it from. Now, if you did a 5-year loan for the same $10,000, you'd end up paying only $180 a month, but keep in mind it's going to be on your liabilities for another year, and you're going to end up paying $781 in total interest versus the $624. So for that one extra year, you end up paying almost $160 additional dollars just to borrow the money. So what's my recommendation? If you can go without taking a loan, don't take a loan. If you need to take a loan, get the minimum amount that you need. So if let's say you have $2,000 and you're buying a $10,000 car, use that $2,000 and get a loan for $8,000. And also do the shortest time period possible, so then you can get that liability payment off, you can own the car outright, and then if you need more cash, you can refinance against the car title again later. That might be an entirely different video, but those are my recommendations. So hopefully this helps. If you have questions, leave a comment, or if you have my number, text me. But these are just 2 quick videos, and I may upload more on what to think about when purchasing a new vehicle.